If you're a landlord, you know rent and repairs. You probably even know property taxes by heart. But depreciation, that's where many landlords can lose money without even knowing it. Hi, my name is Angeline Smith, and I share content on strategic business operations, financial compliance, and profit optimization. In this video, I'm breaking down what depreciation really is, why skipping it can cost you money, and how to make sure the IRS doesn't keep what's really yours. Now, let's go step by step through the 5 things that every landlord and rental property investor needs to know about depreciation, starting with the foundation. Depreciation isn't a loophole, it's a built-in tax benefit. It lets you recover the cost of your rental property and its long-term improvements over time as they wear out or lose value. Each year, the IRS allows you to deduct a portion of that cost, even though no cash leaves your pocket. It's how you match your property's gradual wear and tear with annual tax savings. Now that we know what it is, let's talk about number 2, why depreciation should matter to every landlord. Depreciation directly reduces the income you're taxed on. So when you skip it, you're literally paying more tax than the law requires. And here's the kicker. When you sell, the IRS will pretend you took those deductions even if you didn't, and tax you as though you had. That means you lose the benefit now and still owe later. All right, so what can you depreciate? That's number 3, commonly depreciated items. Here's where that building versus land rule comes in. You can only depreciate the structure itself, not the land it sits on. Beyond that, you can also depreciate appliances, light fixtures, and carpet over about 5 years. Major improvements like roofs, HVAC systems each have their own timelines. Repairs are different. They're deductible right away, not depreciated. And now for the part that many landlords never see coming. Number 4, the recapture trap. When you sell your property, the IRS wants to recapture that depreciation you've taken, or should have taken, by taxing it as income. So if you didn't claim depreciation all those years, you don't get a pass. You simply lose thousands in deductions you were entitled to, and you still face the same tax bill later. That's the double hit I see all the time. Unnecessary tax now and no benefit later when you sell. So how do you get it right from the start? That's number 5, taking depreciation the right way. Start with your property's cost basis. That's your purchase price minus the value of the land. Each year, depreciation gets reported on IRS Form 4562 and carried over to your Schedule E. Track every improvement separately because each one depreciates differently. And document everything. The IRS doesn't argue with organized proof. So here's the bottom line. Depreciation isn't optional. It's your money. The IRS built it into the rules so you can recover the cost of your investment over time. Now, let's look at what that really means for you. When you don't claim depreciation, you're not just missing a deduction. You're forfeiting part of your return. The IRS will still tax you on it later, whether you took it or not. That's why I always tell my landlord clients, take it, track it, and keep what's yours. If you found these insights helpful, I think you'll benefit from my free Schedule E compliance guide. In it, I outline the 5 QuickBooks Online customizations every landlord needs to stay audit ready and tax compliant. You can get my free guide by going to asmith-accounting.com/free compliance-guide. The link is on your screen and in the description of this video. Protect your rental income. Protect your peace of mind. Get the guide today.